You've probably heard someone brag about having travel hacked their way to a free vacation using credit card points. And you've also probably heard another person whisper, much more quietly, that they're drowning in credit card debt because of a few small purchases that spiraled out of control. Same tool, two completely different outcomes. And the strangest part? Most people don't realize which side they're drifting toward until the consequences are already shaping their future. Before we dive in, this video is for educational purposes only and is not financial advice. Always do your own research or talk to a licensed professional for personalized guidance. Now, here's what most people never stop to consider. Credit cards are one of the only financial tools where the marketing sounds like it belongs on a fitness commercial. Words like points, rewards, bonuses, cashback, perks, all dripping with excitement, all designed to make you feel like you're winning some sort of game. But credit cards aren't a game. They're a contract, and they're structured in ways that most consumers don't fully understand. The truth? There's an entire economics-driven ecosystem behind why credit cards exist, what banks secretly want you to do, and how the average person can either use this tool to accelerate their long-term financial health or quietly sabotage it, one swipe at a time. So to set the stage, I want you to picture not a scenario, not a dramatic morning, not a what if, but a simple number, 20.99%. That's not some random figure. It's the average interest rate many credit cards charge. And that number alone tells a bigger story than any dramatic introduction ever could. Because that single percentage is the dividing line between using a credit card as leverage and becoming someone else's source of profit for years. But let's zoom out. Let's look at the real win. Understanding how to control credit, manage debt, and make today's financial moves work in your favor tomorrow. Not just in theory, but in predictable, repeatable ways. Credit cards are often the first adult financial product people get access to. But the way they're introduced, especially to young adults, is almost comical. Instead of explaining what a revolving line of credit actually is, how interest accrues, what utilization truly means, or how payment history impacts every loan you'll ever apply for, society treats credit cards like a simple convenience tool. Tap, swipe, walk away. But behind each swipe is a data point that affects your long-term financial profile, shaping how lenders view you, how much interest you'll pay on future loans, and how much opportunity or restriction your financial life will contain. So to set the stage, I want you to picture not a scenario, not a dramatic morning, not a what if, but a simple number, 20.99%. That's not some random figure. It's the average interest rate many credit cards charge. And that number alone tells a bigger story than any dramatic introduction ever could. Because that single percentage is the dividing line between using a credit card as leverage and becoming someone else's source of profit for years. But let's zoom out. Let's look at the real win. Understanding how to control credit, manage debt, and make today's financial moves work in your favor tomorrow, not just in theory, but in predictable, repeatable ways. Credit cards are often the first adult financial product people get access to, but the way they're introduced, especially to young adults, is almost comical. Instead of explaining what a revolving line of credit actually is, how interest accrues, what utilization truly means, or how payment history impacts every loan you'll ever apply for, society treats credit cards like a simple convenience tool. Tap, swipe, walk away. But behind each swipe is a data point that affects your long-term financial profile, shaping how lenders view you, how much interest you'll pay on future loans, and how much opportunity or restriction your financial life will contain. So let's break this down from the ground up, starting with a concept most people misunderstand: credit. Credit at its core is nothing more than a measurement of trust. A credit card isn't giving you money you earned. It's giving you money someone else trusts you to pay back. And that trust is constantly measured, evaluated, scored, and updated based on your behavior. This is why everything you do with your credit card is essentially contributing to a long-term reputation. Your credit score is your financial resume. But unlike a traditional resume, you don't get to curate the story. Every late payment, every dollar of utilization, every mistake, every positive habit. It's all logged and scored. Let's talk about that score, because it matters more than people realize. A high credit score can save you tens of thousands of dollars throughout your life. Not because of credit cards themselves, but because interest rates on mortgages, auto loans, and even personal loans all hinge on that score. A better score means you're seen as less risky. Less risky means the lender can afford to offer you better terms. Better terms mean you pay less over time. And here's where the ripple effect begins. People often think being good with credit cards simply means paying their bill on time. And yes, that's important, vital actually, but that's just the entry level. A more accurate measure of mastering credit is how well you understand your credit utilization, how consistently you keep it low, and how many months and years you maintain that pattern. Let's take utilization for a moment. Most people hear the rule of thumb, keep it under 30%. Good advice? Sure. Optimal advice? Not quite. The truth is, people with the highest credit scores often use less than 10% of their available credit. Not because they don't spend money, but because they understand the psychology of credit scoring models. Lower utilization signals lower risk. Think of it like this. A person with a $10,000 limit who consistently carries a $3,000 balance might think, I'm under 30%, I'm fine. But to a scoring model, this person is still using nearly a third of their available credit. That implies reliance, and reliance implies risk. Now imagine someone else with the same limit, but only using $200 or $300. That signals control and stability. That difference in behavior can be the difference between a 690 and a 760 credit score. And that gap could mean paying thousands less in interest on a car loan or tens of thousands less on a mortgage. But credit utilization isn't even the biggest factor. Payment history is. A single late payment can haunt your score for years. It's one of the most expensive financial mistakes a person can make, even if the missed payment was small. And late payments don't just lower your score, they also trigger penalty APRs, meaning the interest rate on your card can shoot up dramatically, making your existing balance even heavier. It's a cycle, the type of cycle credit card companies profit from. And that brings us to one of the biggest misunderstandings about credit cards, the idea that they are inherently dangerous. Credit cards aren't dangerous. Misuse is dangerous. Lack of knowledge is dangerous. The tools themselves can actually be incredibly powerful if used strategically. To understand why, you need to know how credit card companies make money. Most people think it's primarily through interest, and it is a major source. But that's not their only revenue stream. They also earn some merchant processing fees, annual fees, penalties, and even your data. That's why credit cards can offer rewards, because they're already making enough on the back end to justify giving you incentives on the front end. But remember, rewards are designed to influence behavior. They exist because companies know the average person will spend more, not less, when they feel like they're getting something. Spoiler, they don't. Yet, despite this, responsible card users can absolutely benefit from rewards. Cashback, travel points, extended warranties, purchase protection. These are real perks with real value. But they're only valuable if the user doesn't pay interest. This is the real divide. The person who pays their balance in full each month benefits from the perks. The person who carries a balance month after month pays for the perks. So the question becomes, which side of that line do you fall on? And if you're on the wrong side of it, how do you cross back over? One of the biggest reasons people fall into credit card debt isn't overspending, it's incorrect timing. Not understanding billing cycles, statement dates, interest calculation methods, or how minimum payments work. For example, many people think that carrying a small balance helps your credit score. That's a myth. You can pay your card in full every month and still build excellent credit. And speaking of paying in full, not everyone knows that the interest on credit cards doesn't apply to your full balance, only to the amount you carry past the due date. If you pay the statement balance every month, you avoid interest entirely. Yet millions still pay interest simply because they misunderstand what the statement balance actually is. Then there's the snowball effect of missed payments, rising interest, and the psychological weight of debt. Many people aren't taught how to climb out of that hole efficiently. Strategies like debt snowball, debt avalanche, consolidation, balance transfers. These concepts aren't complicated, but they are rarely explained clearly.
So why does understanding all of this matter? Because the financial decisions you make in your 20s, 30s or 40s compound over time, just like interest. Except in this case, the compounding can work in your favor. A person who uses credit cards strategically can establish a strong credit history, avoid unnecessary interest, and leverage their score to secure lower rates on future loans. They can use their credit line as a buffer for emergencies instead of falling into panic mode. They can take advantage of rewards without being exploited by them. A person who doesn't understand credit cards can end up paying interest for years, damaging their score with mistakes they don't know they're making, and funding someone else's profits instead of building their own financial stability. So the real topic of this video isn't just credit cards, it's about control. It's about making deliberate financial decisions today that position you for a more stable tomorrow. It's about understanding how debt works, how lenders think, and how everyday choices turn into long-term consequences, positive or negative. And that understanding starts with something simple, separating the tool from the behavior. Credit cards don't create debt, behavior does. And behavior can change, improve, and be refined with the right knowledge. We're going to dig deeper into how debt accumulates, how to manage it, how to eliminate it, and how to use these financial tools in ways that protect, not harm your future. But clarity has to come first. Once you see how the system works, you start playing a different game entirely, one where you control the outcomes instead of reacting to them. When you begin to look closely at how debt forms, especially through credit cards, you realize it's rarely caused by one big purchase. It's almost always the accumulation of small decisions made with incomplete information. People think of debt as a single heavy weight, but in reality, it's more like fine dust. It settles quietly, invisibly at first, until suddenly it covers everything. And at that point, cleaning it up becomes a much bigger job than expected. To understand credit card debt on a deeper level, it helps to separate the emotional side from the mathematical one. Emotionally, people often feel embarrassed, guilty, or stressed when they're in debt. They might hide it, avoid talking about it, or deny how serious it has become. But mathematically, credit card debt is just numbers that follow clear rules. And while emotions can cloud judgment, numbers never lie. One of the biggest misconceptions about debt is that someone is irresponsible. That's not universally true. Many people fall into debt because of unexpected emergencies, medical expenses, sudden job loss, car repairs, family obligations. Others fall into it slowly because their cost of living rises faster than their income, and then there are those who fall into it due to habits developed long before they fully understood the consequences. This is why it's important to break down how debt compounds over time. Credit card interest doesn't grow in a straight line. It grows exponentially. This means that carrying a balance from one month to the next isn't just postponing payment, it's creating additional debt that grows on top of itself. The longer it sits, the heavier it becomes. If someone has a balance of $2,000 on a card with a 20% interest rate and makes only minimum payments, they might believe they're making progress. But the truth is, the majority of that minimum payment is going toward interest, not principal. The principal shrinks slowly, almost painfully slowly. In some cases, it could take years, sometimes over a decade, to pay off a balance if the borrower sticks to minimum payments. And during that time, they might pay more in interest than the original amount they borrowed. This is why minimum payments, while seemingly helpful, can trap people in a long-term cycle of debt. They're designed to keep the account in good standing while maximizing profit for the lender. It's a structure that benefits the issuer far more than the consumer. But here's the crucial point. Once someone understands this, they gain leverage. Once they see how the system is structured, they can reverse engineer it to regain control. Let's talk about two major methods people use to eliminate debt: the debt snowball and debt avalanche. Both approaches can work, and understanding them can mean the difference between struggling with debt for years or eliminating it much sooner. The debt snowball focuses on paying off the smallest balances first, regardless of interest rate. The psychological win of eliminating entire debts quickly gives people momentum. Each paid-off balance acts like a small victory, reinforcing discipline and building confidence. For many, this psychological lift is more powerful than the interest savings of the avalanche method. On the other hand, the debt avalanche focuses on paying off the debt with the highest interest rate first. Mathematically, this method saves the most money because it reduces the amount of interest accumulating over time. It's the more efficient approach from a numbers standpoint. Which method is better? It depends on the person. Someone who struggles with motivation or feels overwhelmed by debt may benefit from the snowball method. Someone who is more mathematically driven and comfortable with delayed gratification may prefer the avalanche method. The key is choosing a method and sticking to it consistently. But eliminating debt isn't just about tactics. It's also about understanding how habits and behaviors impact financial outcomes. This means looking at spending patterns and identifying the root causes behind the debt. People often talk about budgeting as if it's simply writing down numbers. But real budgeting is understanding behavior. It means tracking where money actually goes, not where you think it goes. And for many individuals, the gap between those two images is surprisingly large. There's a reason subscription-based companies thrive. People forget about recurring charges. There's a reason impulse purchases are so common, because small transactions don't feel threatening. There's a reason credit cards are structured to create ease of use. The brain interprets swiping a card very differently than handing over cash. In fact, research shows that people spend more when using credit versus cash because the pain of spending is delayed and diffused. Knowing this allows people to build strategies that counteract the psychological traps built into modern spending. For example, some cut their reliance on credit cards while paying off debt, choosing to use debit or cash temporarily. Others set strict purchase rules, like waiting 24 hours before buying anything non-essential. Some create accountability by sharing goals with a partner or friend. But there's another layer to credit card debt that often goes unnoticed: the connection between financial stress and decision-making. When people feel anxious about money, their cognitive bandwidth shrinks. They may make reactive decisions, avoid opening statements, or convince themselves they'll deal with it later. This leads to missed payments, higher balances, and more stress, creating a feedback loop that reinforces the problem. Breaking that loop requires both understanding and action. It requires looking at a credit card statement not as a source of shame, but as a source of information. Every line item is a clue about habits, patterns, and opportunities for improvement. For example, many people don't know the difference between a statement balance and a current balance. This confusion can lead to unnecessary interest charges. Paying the statement balance by the due date avoids interest, even if the current balance is higher due to recent transactions. Others don't understand how payment allocation works, meaning that when they pay extra, the money often goes toward lower interest balances first, unless they specify otherwise. And then there's the topic of credit limits. The higher the credit limit, the easier it is to keep utilization low. Yet many people never request limit increases, often because they assume it will hurt their score or lead to a hard inquiry. In many cases, limit increases can be requested with soft pulls, no harm to the score, and they provide more breathing room. Understanding these mechanisms transforms credit from something intimidating into something predictable. Once the system is predictable, it becomes easier to manage. And once it's easier to manage, it becomes easier to use strategically rather than reactively. Another critical concept when dealing with debt is recognizing when consolidation may be helpful. Consolidation doesn't reduce the amount owed, but it can reduce the interest rate. Rolling multiple high-interest credit cards into a single lower-interest loan or line of credit can accelerate repayment. It simplifies the structure: one payment, one interest rate, one timeline. This can reduce stress and improve repayment consistency. Balance transfer credit cards can also offer relief. Many provide 0% interest for an introductory period, typically 12 to 18 months. This means every dollar paid goes directly toward principal instead of interest. For someone actively working on paying off debt, this can dramatically shorten the timeline. But balance transfers come with rules. If the balance isn't paid off by the end of the promotional period, the interest rate can jump sharply. Some cards charge transfer fees that offset some of the savings. And if someone continues using their old cards while paying off the transferred balance, they can end up deeper in debt than before. This is why consolidation and balance transfers require careful discipline. They are tools, not solutions. The underlying habits must shift for the results to last. As people work through debt, something interesting begins to happen. Their mindset changes. They move from feeling powerless to feeling in control. They start to see debt not as a defining feature of their financial lives, but as a temporary challenge they have the tools to overcome. And that's where the idea of long-term financial health comes into play. The moves someone makes today, understanding credit, managing debt, controlling spending, have long-term consequences. Eliminating debt not only frees up money, but also improves credit scores, lowers stress, and opens doors to better financial opportunities. For example, someone with high credit card debt might struggle to qualify for a mortgage, but once that debt is reduced or eliminated, their credit utilization drops, their score rises, and their debt-to-income ratio improves. Suddenly, home ownership becomes more attainable. Lower debt also means more cash flow, which can be redirected towards savings, investments, or future goals. This is why it's important to see credit management not as a chore, but as an investment in your future freedom. Debt may feel heavy today, but the process of eliminating it builds discipline, insight, and confidence. And those qualities carry forward long after the debt is gone. Credit cards themselves aren't the enemy. They're tools. Tools that can either build or break depending on how they're used. Used wisely, they offer protection, flexibility, and rewards. Used carelessly, they drain wealth and limit opportunity. The difference isn't luck, it's knowledge and behavior. And as you continue to build that knowledge, the picture of your financial life becomes clearer. You start to move from reacting to planning, from scrambling to strategizing. You begin shaping your financial future instead of letting circumstance shape it for you. As someone builds a clearer understanding of how credit cards and debt function, another essential concept emerges: financial leverage. Leverage isn't just a term used by investors or corporations. It's something every individual uses, consciously or not, whenever they borrow money. And credit cards, for better or worse, represent one of the most accessible forms of personal leverage. Leverage can amplify either good decisions or bad ones. When used wisely, it accelerates progress. When used poorly, it magnifies problems. This is why mastering credit cards is less about avoiding them entirely and more about using them deliberately, with full awareness of their mechanics and long-term effects. Many people assume leverage is something only wealthy individuals use to grow their money. But everyday consumers use leverage whenever they finance a car, take out a mortgage, use student loans, or swipe a credit card. The difference lies in whether the leverage is helping them move forward or holding them back. Credit card debt, when uncontrolled, becomes negative leverage. It drains income today and steals financial opportunity tomorrow. But credit cards used responsibly, paying the balance in full, keeping utilization low, building payment history, create positive leverage by strengthening credit worthiness. And credit worthiness plays a pivotal role in almost every major financial decision. Imagine two people applying for the same auto loan. One has a credit score of 620, the other 760. The person with the lower score might get approved, but they'll pay significantly more over the life of the loan due to higher interest. The difference could be thousands. That's the hidden cost of poor credit management. The numbers don't show up on a credit card statement, but they show up everywhere else later. And this is where today's financial moves begin to ripple into tomorrow's financial reality. The habits cultivated now determine which version of the future becomes possible. But creditworthiness isn't just about big purchases. It affects daily life in ways many people never consider. Landlords check credit when renting apartments. Insurance companies sometimes use credit-based insurance scores to determine premiums. Employers in certain industries may review credit histories as part of the hiring process.
Poor credit doesn't just cost money, it limits choices. This is why building and maintaining good credit isn't just about avoiding stress. It's about positioning yourself for better opportunities. And to do that, understanding the deeper mechanics of credit scoring becomes essential. A credit score isn't a moral judgment, it's a risk model, a prediction of how likely you are to repay borrowed money. And like any model, it relies on specific data points. Payment history carries the most weight. This means on-time payments aren't just a good habit. They're a powerful reflection of reliability. A single missed payment can linger on a report for 7 years, and the impact is most severe when the rest of the credit history is thin. This is why consistency matters more than perfection. A string of on-time payments month after month builds a strong foundation that makes occasional mistakes less damaging. Next is utilization, something many underestimate. Even if you pay the balance off every month, high reported utilization can temporarily lower your score. The trick is understanding that credit bureaus measure what's on your statement, not what's in your bank account. Paying down balances before the statement closing date, not the due date, helps ensure the reported utilization is low. It's a simple timing adjustment that can make a significant difference. Then there are factors like credit age, credit mix, and new credit inquiries. These matter too, not because they reveal spending habits, but because they reflect how you handle various forms of credit over time. Someone with a long history across different account types shows more predictability, and that predictability translates into trust from lenders. But beyond these mechanics, there's a broader question. How do people move from struggling with credit or debt to managing it confidently? One of the most transformative steps is creating a structured financial plan, even if it starts with something simple. It could be as straightforward as listing all current debts, interest rates, and minimum payments. Seeing everything in one place provides clarity. Clarity reduces stress, and reduced stress opens the door to better decision-making. From there, the next step is building a buffer, something that many overlook when trying to escape debt. Without an emergency fund, even the smallest unexpected expense can push someone back into the cycle. A flat tire, a medical copay, a broken appliance, these things always show up sooner or later. Without savings, they land on the credit card again, undoing progress. This is why even a small emergency fund, $300, $500, $1,000, can be a game changer. It doesn't eliminate the need for credit, but it reduces reliance on credit to cover predictable surprises. And with less reliance comes more control. Once an emergency fund is in place, debt repayment accelerates. Money that previously would have been used to plug emergencies now goes toward debt reduction. Progress becomes faster, motivation grows, and financial habits solidify. But there's another level people reach as they gain control: the shift from defensive to offensive financial strategy. Defensive strategies involve stopping the bleeding, paying debt, reducing overspending, building savings. Offensive strategies involve using credit cards to optimize financial life. This includes maximizing rewards without paying interest, benefiting from purchase protections, leveraging extended warranties, earning travel points, and building credit deliberately for future opportunities. It also means understanding how to choose the right credit card. Many people select cards based on flashy rewards without considering annual fees, interest rates, or redemption structures. But an educated cardholder looks deeper.
They know to choose cards that match their spending patterns. They evaluate whether an annual fee is justified by the benefits. They understand how category bonuses work, how points transfer to travel partners, and how cashback structures operate. They see cards not as spending stimulators, but as financial tools that either add value or extract it. For example, a card offering 1% cash back may seem good until you realize another card offers 2% with no annual fee. A travel card offering lounge access may sound exciting until you realize your airport rarely has lounges in that network. A card advertising a huge sign-up bonus may be tempting until you see the high minimum spending requirement. This is why strategy matters. Every card should serve a purpose. If it doesn't, it becomes a liability. But as someone grows more strategic, they also need to navigate the fine line between maximizing credit card benefits and overcomplicating their financial life. Too many cards can create chaos if not managed properly. Payment dates can become confusing. Balances can be harder to track. points can sit unused. The goal isn't to collect cards, it's to collect value. At the same time, closing cards harms credit age, which can temporarily lower scores. This is why many people keep old cards open even if they rarely use them. They might put a small recurring charge on the card just to keep it active, ensuring it contributes to their credit history. And while managing multiple cards can feel overwhelming at first, technology helps. Automatic payments for statement balances prevent accidental late payments. Budgeting apps categorize spending. Account alerts notify when balances grow too high. Even simple spreadsheets can create clarity. When organized, managing credit becomes far easier and far more effective. But knowledge alone isn't enough. Mindset plays an equally important role in shaping long-term financial outcomes. People often underestimate how deeply emotions influence their spending choices. Stress, boredom, excitement, frustration, these states can all lead to impulsive purchases. Recognizing triggers is a crucial part of financial self-awareness. For some, shopping becomes a way to cope with emotional discomfort. For others, it's a way to celebrate. For many, it's simply a habit formed over years of convenience. None of these patterns are fixed. They can be reshaped through self-reflection, intentional rules, and new routines. And that's what financial maturity ultimately looks like, understanding not just the numbers, but the behaviors behind them. It's recognizing that financial success isn't about perfection, it's about consistency, awareness, and adaptability. The next layer of growth comes from something most people don't consider until later: future planning. This includes preparing for large expenses months or years in advance instead of relying on credit cards as a last-minute solution. Saving for car repairs, future travel, holiday expenses, or even predictable life events helps reduce the likelihood of falling back into debt. When someone transitions from using credit cards reactively, responding to emergencies, to using them proactively, they enter a different financial category altogether. They still use credit, but they're no longer dependent on it. And that's the key distinction: dependence versus strategy. Dependence drains financial resources and limits freedom. Strategy multiplies financial options and strengthens long-term stability. And the shift from one to the other doesn't happen overnight. It happens step by step, decision by decision, habit by habit. It happens when someone chooses to understand how credit really works, when they decide to confront debt instead of avoiding it, when they build their emergency fund, when they refine their spending habits, when they use credit cards consciously instead of impulsively, and when they realize the financial future they want is built not on big, dramatic moments, but on small, consistent actions. And the more someone leans into these actions, the clearer the transformation becomes. They move from feeling stressed to feeling organized, from feeling stuck to feeling empowered, from feeling reactive to feeling confident. And that confidence becomes the foundation for making smarter choices, exploring new opportunities, and building a financial life that aligns with their goals. As your understanding deepens and the relationship between credit cards, debt, and financial behavior becomes clearer, another critical layer emerges: the role of long-term habits in shaping lasting financial resilience. Because while strategies and tools matter, what truly determines financial outcomes over years or decades is consistency. The small, repetitive choices you make become the architecture of your financial identity. One of the most overlooked truths about money is this: most financial success is built on autopilot, not on intense bursts of discipline, but on systems that quietly run in the background. People who thrive financially are rarely those making the largest income or the boldest investments. They're usually the ones who built systems to support good behavior and limit bad behavior. And credit card management is no exception. Take automation, for example. In the world of personal finance, automation is a form of self-protection. Setting up automatic payments for the full statement balance removes the risk of forgetting a due date. Automating transfers to savings eliminates the temptation to spend money meant for future security. Even automating bill reminders or spending alerts creates a cushion against impulsive decisions. Without these systems, people rely on willpower alone. And willpower is fragile, it's inconsistent.
It weakens when life gets stressful, when schedules get chaotic, or when motivation dips. But systems don't depend on emotions. They run regardless of how someone feels that day. This is why setting up structure is one of the most powerful ways to maintain control over credit cards and debt. With the right systems in place, even unexpected life events have less power to derail progress. But alongside systems, another long-term skill becomes essential: financial awareness. Awareness isn't just knowing your balance or checking your statements. It's the practice of periodically reviewing your financial life from a wider lens. It's stepping back and asking questions like, where is my money actually going? What patterns keep showing up? What expenses are creeping up without me noticing? Are my financial tools still aligned with my goals? Is my debt shrinking, growing, or stagnating? Most people never ask these questions, at least not until something stressful forces them to. But those who build the habit of regular review gain an advantage. They catch overspending earlier, they spot unnecessary fees, they notice when a card's benefits no longer justify the cost. They identify opportunities to increase limits, improve rewards, or optimize payment timing. And beyond awareness, there's the matter of intentional spending. Intentional spending doesn't mean being cheap. It means being aligned. It means deciding in advance what matters and what doesn't, so you can spend confidently on the former and avoid wasting money on the latter. Many people fall into debt not because they are careless, but because their spending is misaligned with their values. For example, some people truly value travel, so they may happily use a credit card offering travel points and justify certain expenses to maximize rewards. Others prefer cashback cards because they want simple, tangible returns. Others enjoy premium card benefits like lounge access or extended warranties. The key is not which preference someone has. The key is whether those choices reflect what they actually value or whether they're influenced by marketing, impulse, or habit. Credit cards become dangerous when used unconsciously, but when used with consciousness and intention, they become powerful tools. Another long-term part of credit management involves learning how to navigate financial setbacks without losing progress. Because no matter how disciplined or informed someone is, setbacks happen. A job loss, medical bill, emergency expense, these moments can disrupt even well-structured plans. The difference is that someone who understands credit and debt is better equipped to absorb financial shocks without spiraling into debt. Take credit utilization, for example. If someone with a $2,000 limit suddenly has to put a $1,500 expense on their card, their utilization shoots up to 75%. This could temporarily drop their credit score. But someone who has planned well might have a limit of $10,000, making that same $1,500 expense only 15% utilization. The score impact is minimal. The emergency is still stressful, but the long-term damage is contained.
Another aspect of resilience is understanding how to communicate with lenders. Many people don't realize they can call credit card companies to request lower APRs, negotiate fees, or set up payment plans during financial hardship. Lenders aren't always flexible, but many have hardship programs designed to support customers during temporary struggles. Yet most people never use these options because they don't know they exist or they feel uncomfortable asking. Understanding and using these programs is not only smart, it's strategic. A single fee waiver or temporary rate reduction can make a meaningful difference during difficult times. And once the crisis passes, getting back on track becomes far easier. But resilience isn't only about reacting effectively, it's also about preparing effectively. And that brings forward another long-term theme: distinguishing wants from needs in a way that supports, not restricts, your financial life. For some, needs and wants blur together. Technology, fashion, dining out, entertainment, modern society encourages consumption. Credit cards amplify that encouragement by removing the immediate pain of spending. And when wants consistently masquerade as needs, debt becomes almost inevitable. But when someone learns to slow down, reflect, and evaluate purchases with clarity, their entire financial dynamic shifts. Intentional spending is a long-term habit that transforms the role credit cards play in someone's life. Instead of being used to satisfy impulses, cards become tools to support goals. Instead of being used to fill emotional gaps, they're used to build financial stability. Instead of being used thoughtlessly, they're used strategically. With this shift comes another: understanding the long-term impact of opportunity cost. Every dollar spent today has a hidden price, what that dollar could have become if invested or saved. This is especially true with debt. A dollar paid in interest is not just a dollar lost today, it's a future benefit lost as well. When someone pays high interest credit card debt month after month, they aren't just losing money, they're losing time, because time is what makes money grow. This realization often becomes the turning point for people working toward financial stability. They begin to see interest not as a number on a statement, but as a drain on future opportunity. The more interest they pay, the more future choices shrink. Conversely, the less interest they pay, the more flexibility they gain later. This concept ties directly into the larger goal of building long-term financial freedom. Financial freedom isn't just about being debt-free. It's about having enough control, stability, and clarity to make decisions from a place of choice, rather than necessity. It's the difference between needing to use credit and choosing to use credit, between relying on debt and leveraging credit strategically. And strategic leverage becomes especially powerful when combined with long-term financial planning, because credit cards, when managed well, can actually accelerate wealth building in ways few people consider. For example, strong credit can lead to lower interest rates on a mortgage, potentially saving tens of thousands of dollars. Those savings could then be invested, multiplied over time, and used to build assets that create additional income. Lower interest on auto loans frees up money that can be redirected toward retirement savings. Credit card rewards, when used responsibly, can offset travel costs or provide cashback boosts to monthly budgets. But the greatest long-term value comes not from rewards or perks, but from the financial stability that responsible credit management creates. Once debts are under control, once savings are consistent, once financial habits are aligned, the real opportunities begin to reveal themselves. People often underestimate how much mental clarity and confidence come from being in control of their finances. That confidence fuels better decision making, cleaner planning, and more ambitious goals. Someone who no longer fears their credit card statement starts planning for investments. Someone who eliminates debt starts thinking about home ownership. Someone who builds savings begins exploring new career opportunities without fear of financial instability. Someone who understands credit deeply starts using it as a tool instead of a crutch. And this is the long-term transformation credit mastery creates. Not just freedom from debt, but freedom to choose, freedom to build, freedom to plan, freedom to take risks safely, freedom to grow financially without the weight of revolving balances holding you back. And at this stage, the conversation shifts. It moves away from survival and toward optimization, toward building systems that make your financial life smooth, efficient, and aligned with the future you want. But the growth doesn't stop there. There's one final component that ties all of this together: the ability to sustain financial discipline even when life becomes comfortable. Many people lose control of their credit not during struggle, but during abundance. Extra income can create a false sense of security. People begin spending more freely, assuming they will make up for it later. Credit card balances grow again, not out of necessity, but out of loosened habits. Sustaining financial discipline doesn't mean living in scarcity. It means respecting the systems that keep your financial life healthy. It means continuing to track spending even when money feels abundant. It means keeping utilization low even when limits increase. It means resisting the temptation to let lifestyle creep consume future security. Because true financial strength is not measured by how someone performs when money is tight. It's measured by how they maintain control when money is flowing easily. And when someone reaches that level of discipline, they've reached the point where credit cards are no longer sources of stress or risk.
They simply become tools, powerful ones that fit into a larger plan built on clarity, resilience, and long-term thought. You start to feel something shift. Not because your income suddenly tripled, not because your expenses magically shrank, and not because you unlocked some secret millionaire cheat code, but because for the first time you're operating with full awareness. You're no longer reacting to money, you're directing it. And that shift, subtle at first, begins to ripple through every financial choice you make. Because here's the truth almost no one tells you. Once you understand how credit cards and debt truly work, you don't fear them anymore. You don't treat credit like a grenade that might explode in your wallet. Instead, you treat it like a tool, sharp, powerful, useful, but only effective if you handle it with intention. And that brings us to the future version of you. Picture your life a few years from now. Not with a dramatic scene or a fantasy lifestyle, but with something far more real. Options. Because everything you've learned in practice, shaping your spending awareness, understanding utilization, managing balances, leveraging rewards responsibly, protecting your credit score like a future asset, these choices come together quietly, gradually, consistently. And then one day they start to pay you back in ways that go beyond money. Buying a home, you can qualify with a stronger score and lower rates. Starting a business, you have the credit profile to get funding. Making a big purchase, you're not forced into overpriced financing. Facing an unexpected emergency, you don't collapse financially. It's an inconvenience, not a catastrophe. This is what smart financial moves are really about. Not getting rich overnight, not becoming some credit hacking guru, and not memorizing every trick or loophole that floats around online. It's about setting your future self up with stability, leverage, and confidence. And sometimes that starts with understanding the simplest of truths. Debt itself is not the enemy. Unmanaged debt is. And credit cards are not traps by default. Uninformed usage turns them into traps.
When you know how they work, you regain control. When you act intentionally, you remove the guesswork. When you choose discipline over impulse, you build something that compounds, something no algorithm can calculate perfectly. Financial resilience. Now, resilience doesn't mean perfection. It doesn't mean you'll never overspend again, or that you'll flawlessly pay your balance every month without human moments. But resilience means you understand why you're making each choice. You understand that the cost of debt and the value of credit. You understand the long-term consequences of short-term habits. And most importantly, you understand that small decisions made consistently can lead to massive differences over time. Because despite what it may look like online, financial success isn't built with dramatic moves. It's built with boring consistency, strategic awareness, and patient discipline. Things like paying your balance on time, tracking your utilization, avoiding unnecessary fees, keeping old accounts open to lengthen your credit age, only using credit for purchases you can genuinely afford, setting up reminders so payments never slip, knowing when to say no to temptation even if it's only $20 here or $50 there. These are the habits that stack. These are the choices that matter. These are the moments that compound silently in the background of your life. And one day, without fanfare, you look up and see how far you've come. Your credit score rises not because of one heroic action, but because of hundreds of tiny disciplined ones. Your debt shrinks because you chipped away at it consistently. Your interest payments shrink because you learned how credit works. Your anxiety about money decreases because you're no longer operating in uncertainty. Your future becomes clear because you're moving with intention. And through all of this, something interesting happens. You start to feel a sense of control, a sense of empowerment, a sense that you're building your life, not reacting to it. Credit cards stop being stressful. Debt stops being shameful. Money stops being confusing. Instead, it becomes a system you understand, a tool you can use, and a pathway you can walk with confidence. Because at the end of the day, the goal isn't to avoid credit forever. It's not to fear debt forever. It's not to live a life trying to dodge financial mistakes. The goal is to develop an understanding so strong and a mindset so steady that mistakes don't destroy you, they teach you. Maybe you've made credit mistakes before. Maybe you're dealing with debt right now. Maybe you're trying to rebuild. Maybe you're starting from scratch. It doesn't matter where you are. What matters is that you're learning to handle your money with awareness, intention, and strategy. And that right there, that's the foundation most people never build. Because most people don't learn how credit works until they've already damaged theirs. Most people don't understand how interest piles up until they're buried in it. Most people don't see the value of financial discipline until they're forced into it. But you're not most people. You're choosing awareness now. You're choosing knowledge now. You're choosing control now. And those choices will separate you from the majority, because the majority only reacts, but you're learning to anticipate. You're learning to plan. You're learning to build, not just survive. The people who end up financially stable aren't the ones who avoid debt entirely. They're the ones who understand it deeply. They recognize which debt is dangerous and which debt is strategic. They recognize which habits help and which habits destroy. They recognize that credit cards are neither saviors nor villains. They're tools. And the person holding the tool, you, determines whether it builds or breaks. So yes, credit cards can cost you thousands if misused. They can create long-term stress if ignored. They can disrupt your financial goals if handled impulsively. But with awareness and discipline, they can also help you save thousands in interest, unlock financial opportunities, and build a foundation most people only dream of. Here's something people don't talk about enough. Financial confidence is not something you finally get when you hit a certain income level. Financial confidence is something you build through behavior, through patterns, through each day's choices regarding credit, spending, saving, and managing your debt. Confidence doesn't come from having more money. It comes from knowing you can manage whatever money you have. And when you know how credit cards work, when you understand how interest affects your decisions, when you see how debt builds or shrinks based on habits, when you take full responsibility for your financial moves, you gain something priceless. Clarity. Clarity about what you can afford. Clarity about what you should avoid. Clarity about what you're working toward. And clarity, combined with consistent action, leads to financial freedom. Not the fantasy version with yachts and passive income flowing in endlessly, but the real version: stability, control, opportunity, and peace. That's the freedom worth pursuing, because when you're no longer suffocated by high-interest debt, when your credit score is strong enough to open doors, when you're no longer terrified of your statements, when you understand exactly how your decisions today shape your life tomorrow, you start experiencing money differently. You start making choices differently. You start living differently. And that version of life, the one built on intention and clarity, is available to you, starting now, continuing every day, strengthening with every small, consistent action you take. Your financial future is not determined by your past mistakes. It's shaped by your current decisions, and you have everything you need to make better ones. Use credit wisely. Treat debt with strategy. Protect your financial future with awareness. And remember, every smart choice you make today has the power to save you time, stress, and money tomorrow. This video is for educational purposes only and is not financial advice. Always do your own research and make decisions based on your personal financial situation. And with that, your understanding of credit, debt, and financial strategy is stronger than it's ever been. What you do with it now, that's the part that shapes your story. If you ever revisit this in the future, you'll realize that today wasn't just about learning. It was about taking control. It was about building the version of you who has options, stability, confidence, and freedom. And that's the real win. Let's make sure your future self is proud of the decisions you start making from this moment forward.